Twitter's US ad sales plunged 59% as woes continue. This is according to internal forecasts, and they're going to go through some of the actual numbers here, but keep in mind what this potentially means as a Tesla owner. It's a potential risk that, hey, is Elon going to have to go back and sell more Tesla? Now, he's argued that he's sold enough to sell for all of 2023, to float 2023, maybe even into 2024. But if Twitter revenue doesn't turn around, he's going to end up having to, well, probably continue to fund the business somehow, and that could be by selling shares in another company. Some people are like, maybe he'll sell shares of Starlink, and I think the answer to that is unlikely that Starlink will have enough liquidity for this. So Tesla will still be that door that he ends up having to knock on. Now, in order to try to support the mission, of course, on my Twitter page, I now pay $1,400 a month to tweet and have this beautiful yellow check mark and a check mark for myself and our team members, just to support the cause of Twitter not going bankrupt here. All right, anyway. So Elon Musk reportedly said Twitter's advertising business was on the upswing. Almost all advertisers have come back, he asserted. And Elon does have an interesting way of being able to kind of see the positive in things. Just I do too, okay? I see the positive in things. But Elon's got a unique knack for talking about how great something is when it's not great at all. So we've seen this with Tesla. Well, let's keep going. Remember January? Demand is very robust. There's no shortage of demand. 5 price cuts later on the cars. Come on, man. Come on. Now, Tesla did just get the full $7,500 tax credit for their Model 3s. That, I have to say, was impressive and almost ingenious. I was doing a little bit of research on this, and it looks like Tesla might have actually been taking an approach to declare that the average number of batteries they make is actually enough to qualify their entire fleet for the $7,500 tax credit. Now, the and the S, the one who's going to pay you this tax credit, has not updated their website yet to indicate that this is true, but the Tesla website certainly does. So clearly they think they have enough of a legal argument to make the claim that $7,500 is yours. P.S. I think you don't need more dudes on the front page of Tesla showing how you could launch the car. You got to turn this into more of the family car. You got to get the ladies involved. Just my take. Tesla's demo is 25 to 45-year-old dudes. They got that on lock. We got to expand that. Just my take. You know, I keep talking about advertising with Tesla and such, and here we go, talking about Twitter advertising, and I'm just going to keep throwing out my opinions, so that way, in the event that the gods are listening, maybe they can hear the criticisms through the fog of, Twitter in this case, and wake up. Anyway, okay. So almost all advertisers have come back, as Elon Musk had suggested. But actually, according to the New York Times, revenue from the 5 weeks from April 1 to the first week of May was $88 million, or down 59% from a year earlier, according to an internal presentation obtained by the Times. So in other words, revenue is actually down 59% from the time that Twitter was actually still owned by Twitter. That's quite a big decline. The company has regularly fallen short of its U.S. sales projections, sometimes by as much as 30%. And the performance is unlikely to improve anytime soon. I remember there was a period where Disney was freaking out because some a troll account ended up getting a yellow check mark, impersonated Disney, and then they were posting hate and all this. Some companies are a little fussy about how the verification process has gone, and to some extent, there's some legitimacy in how the verification process has gone a little awry. But I do believe they're trying their best. What I I would say mostly disagree with is the following here. Twitter's ad staff is concerned that advertisers may be spooked by a rise in hate speech, pornography, as well as ads featuring gambling, marijuana products, and other less desirable products to have your product featured near. I personally haven't seen any of those 3 or 4 things. Hate speech, pornography, marijuana products, gambling products on Twitter. That's not to say it doesn't exist. Maybe anecdotal evidence here isn't great. So let's take a look at what the New York Times is referencing. The New York Times, see, this is an old vid. An old piece. The New York Times is actually referencing this rise in hate speech as December 2nd, a December 2nd piece. And this was shortly, about 6 weeks after Elon Musk took over. And there have been counter studies to this New York Times piece suggesting that maybe the New York Times might be miscounting, or the research body, I think it was a university that ended up putting this together, might be miscounting how they're actually evaluating how many hate speech tweets are rising. Because to some extent, if you have potentially, I'm just going to make an example here. I'm not saying this is potentially how the error was in the ways, but on one hand, you can have hate speech that legitimately bashes a group of individuals on Twitter, and it actually goes viral. It gets a lot of engagement. And then on the other hand, you could have potentially a bot farm that posts, 100,000 tweets, and they get 0 engagement because it's just a bot farm. And then all those 100,000 tweets are hate speech. So now you've got 100,000 tweets that are hate speech, but they get 0 engagement, versus like a real hate speech that actually goes viral that maybe gets 1 million views, right? And it's just 1 tweet. So I do think there's potentially a risk in measuring hate speech by the amount of time that hate speech shows up on Twitter. Because if you use a bot like a research tool or a search tool, and then you're counting no engagement tweets, then you're potentially really skewing data. So I'd like to see the controls of some of these, rise in hate speech arguments, because I don't buy that rise in hate speech argument. However, the New York Times' branding of Twitter as experiencing a rise in hate speech is unfortunately probably, turning into what the New York Times is good at and at reiterating, which is that, sure, their sales must now be going down because obviously there's a rise in hate speech. It's kind of frustrating because it's like, if this was flawed and now everything afterwards is being blamed on this, you almost kind of do make it seem like to advertisers that, oh no, there's a rise in hate speech on the platform. It's a little bit of a problem. We've got this former NBC Universal executive who's starting work today. Obviously, a lot of people wishing her good luck, especially since another head of ad safety just quit this weekend. 90% of the company's revenue has previously come from ads. Obviously, Elon Musk has been trying to prop that up by charging for the blue service so you can get verified, the check mark, or the yellow check mark. If you're an idiot, you pay for that. Oops. But it'll be interesting to see how this evolves. When it comes to valuation, we knew that Twitter was substantially an overvalued purchase back when Elon bought it. We knew that. We talked about it. We said it. We analyzed it. We went through it. So now the expectations are that the company's worth about 20 bill versus 44. That's about a 55% decline. However, internally, I guess Fidelity is marking them all the way down to 15 from 44. That's a decline of about 66%. I'm only disappointed that it's not a decline of 69%. Now, here are some comments like, Twitter feels increasingly unpredictable and chaotic. And personally, I just don't see that. I don't see it that horrible, but okay. Some of the biggest advertisers, including Apple, Amazon, and Disney, have been spending less on the platform than last year. But I also feel like everybody's been spending less on advertising. Large specialized banner ads on Twitter's Trends page, which can cost about $500,000 for 24 hours. That's a lot of money. Are almost always bought by large brands to promote events, shows, or movies. But lately, they've been going unfilled. Ooh. 6 ad agency executives who've worked with Twitter said their clients continue to limit spending on their platform. But you have to wonder, how much of limited ad spending is actually due to the economy? They cited confusion over Musk's changes of service, inconsistent support from Twitter, and concerns about the persistent presence of misleading and toxic content on the platform. I quite frankly, honestly believe that is a great excuse in a bad economy. Okay, all right. The rise of AI images of an image that showed an explosion near the Pentagon. Okay, we already know people are using deep fakes to do silly things. Like, that's going to be true on every platform. I guess all of a sudden people are going to stop advertising on Reddit too because the memes are doing too well. I know it's memes, but, tell me which interview we heard the memes in. Anyway, actually, it'll relate to Elon. Anyway, so some marketers are returning to the platform. Great, fantastic. But anyway, hey, this was him in China, I'm pretty sure. So the point is, yes, there isn't necessarily the absolute best growth at Twitter, and that could create some longer-term potential red flags for when and if Elon Musk is going to need to sell again. Are we highly concerned that this is a really big near-term catalyst? Well, maybe, and that's why you could always get life insurance in as little as 5 minutes by going to metkevin.com/life, paid promotion. Or the other paid promotion, which is get 12 free stocks with Weeble by going to metkevin.com/Weeble. Actually, it's metkevin.com/free. Anyway, it's one of those. But yeah, look, at some point there is a risk Elon might have to sell Tesla shares again. Do I think that's coming in 2023? Unlikely. Do I think that that's really going to affect the stock at this point? Not necessarily, mostly because I think Tesla stock is going to be one of the recipients of the Nike swoosh recovery. And what's crazy about Tesla is not only does Tesla need to Nike swoosh along with the broader market. Here's the Nike stock chart on a weekly basis right now. Not only do we actually need to make this a Nike swoosh, which means you have a sharp down and then a long up to actually turn this into a swoosh, but we'll probably have to break these all-time highs of 414 because Tesla's going to have to start pricing in, or the market's going to have to start pricing in, some of the latest and greatest of Tesla, which would be, hey, it ended up surviving this recession or whatever the heck it is we're going through, period. Hey, now you've got Project Highland, which could be a sub-$30,000 Model 3, which I've regularly contended that the best $25,000 car would just be the Model 3, some kind of refresh of the Model 3. So we'll see what happens there. Then you've got the Cybertruck. Obviously, we'd like to see some more ramping of the Cybertruck in 2024 and the Semi. And of course, that doesn't price in really the how good FSD is getting, full self-driving, or any of the other Megapack expansions that we've recently been seeing, as well as the ramps of other factories. That's not to say Tesla's not going to experience a big load of cash burn, though. Remember at the shareholder meeting when I patted myself on the back here, I convinced Elon to advertise? Haven't seen the implications of advertising it. But on top of that, remember that Elon suggested the next 12 months could be quite difficult for Tesla. I believe one of the risk factors for that is actually cash burn. I really think it's going to be quite incredibly expensive for Tesla to manufacture, I shouldn't say manufacture because that implies ramped, for Tesla to create the manufacturing facilities that they're building, whether that's Northeast Mexico, reinvestments into a Chinese expansion or Shanghai expansion, finishing the ramp at Berlin and Austin, the Megapack factory. These are going to be extremely expensive endeavors. And so the beautiful free cash flow that Tesla had previously enjoyed, I don't think will exist anymore. I'm expecting negative free cash flow. And I expect Tesla's cash to actually go from, as some people have put it, oh my gosh, Tesla has so much cash. They got over $20 billion of cash. I expect that to actually go down pretty quickly. And now keep in mind that as we've reviewed the balance sheet of Tesla previously in the last, say 6 months to 9 months, we've also contended that most of their extra balance sheet money, their extra cash, is quite frankly just payables or is offset by bills that they need to pay. Again, that's not bad, especially if you're a free cash flowing company. But unfortunately, I do think there will be a risk that we're going to go to negative cash flow. But that's okay because Tesla doesn't have any debt. And I do think that Tesla will be able to raise enough cash either through financing or even, I know, buckle up. But yeah, there could be a stock offering in 2023, especially as the price goes up. I would guess that if Tesla stock ended up knocking on the door of $300 again, might see an offering. An offering of, I would probably go for maybe a 10 billion offering at $300. That, just to give you an idea of how horrible that could be for the impact of the stock, I'm being facetious because everybody seems to think that an offering is so horrible. Remember, folks, the point of the stock market, okay? The point of the stock market is to raise capital. Okay, so $300 would put them right about at $1 trillion again. That would be a 1% shift in other words, them raising $10 billion at a $1 trillion valuation is literally selling just 1 extra percent. It's really not that big of a deal. So, point being, am I really worried about Tesla stock in the near term? Do I look worried? No, I'm obviously not worried. I think the Twitter thing, Elon should be Gucci until the end of the year, probably early next year. Tesla's money, yeah, there'll probably be a raise. If that free cash flow sector goes negative, there'll probably be a raise. I mean, let's look at it really quick. So here was Q1. What was Q1? So net cash from operating activities was 2.5. We only had about 400 millis here of free cash flow. I expect that's going to go negative. Flat or negative? Flat would be okay. Because if they could keep investing 2 billies into the factories and it doesn't go negative, that's great. Now you don't have to raise money. But let's say it goes negative to the tune of 500 millis a quarter. Honestly, even negative $1 billion a quarter. That's 4 billies. Raising $10 billion gives you another 2.5 years of basically investment money for your plants and factories and whatever else. Or if you spend twice as much, it gives you another, say, 1.5 years, roughly, 1.25 years. And then when you look at the balance sheet, here's their balance sheet. You know, people seem very convinced that, oh, but Kevin, look, Tesla had 22.4 billions in cash. It's so wonderful. Yeah, I agree with you. They've got lots of cash. That's fantastic. But when we go over here and we look at the bills that we got to pay, right? Let's just take the top two over here. Look at that. That's payables and accrued liabilities. 15.9 billion plus 7.3 already puts you at 23.2 billions of bills you got to pay. And we've got some long-term liabilities in here. Virtually nothing. Long-term liabilities appear to be this line right here. Look at that. It's actually sneaking up. Look how it's been rising, actually. Oh, interesting. I didn't even notice this. This has been sneaking up on me. Look at this other long-term liabilities right here. 3.8, 3.9, 4.3, 5.3, almost 6 billions right here. So we got 6 billions of longer-term debt here. And then the deferred revenue, debt, current liabilities, current portion of debt. Current portion of debt is probably, what is that, another 1.4 over there. So you add this all together, not considering deferred revenue or the current portion of leases. It's generally how I do I do my own balance sheet math in a unique way. I understand that. But I do it as more of a meet Kevin asset test. So we got a 30.6-ish in bills and debts here, right? And offset that by about 22.4 in cash. You know, that's great. But you don't really have a lot of cash left. Now, sure, you do have inventory and receivables. But let's go ahead and drop that inventory in value by about 10%. So that's going to bring us to about 13 billies. 13 billies plus about 3 in accounts receivable. Throw that in. What do we got? You got another about 16 in potential here. What does that leave you with? Well, if you offset all of this, you're left with about 8 bill. That's good, but now you're really starting to run that 8 billies down. You start running that 8 billy down at the tune of say 3 billies a quarter, you're out of money after 2.5 quarters. So you had about 2.5 quarters at a break even on free cash flow if you keep having to spend lots of money on these factories. So I do think that that aligns with roughly somewhere like a December, January money raise. Hopefully when Tesla's around, somewhere around maybe $1 trillion in valuation, somewhere around $300 a share. Do keep in mind, though, as we did with the math, them raising 10 billion isn't the end of the world. It is literally 1% of the market cap. Because it might have a larger impact to float depending on how they raise, it could move a little bit more than that, but it's okay. Like, Tesla's going to get through this. I'm not worried about the sale of more stocks. I would be more worried about Elon selling than I would be about Tesla raising money. But then again, how much more is Elon going to have to add? What, another 3 billion or something like that? That'd be 1/3 of what the company itself needs to raise, another 1/3%. It shouldn't be a big deal, but the problem is it just eats up the order book, right? And that's where it kind of hurts a little bit. And I think that's why we've seen this crazy ride with Tesla. So, long and short of it, there's kind of my wide breakdown of all of this Tesla madness. Now, the good news about all this madness with Tesla and Twitter is you can still check out those programs linked down below on Building Your Wealth, because guess what? You can always check them out. In fact, they're really phenomenal programs. We've got the AI course releasing tomorrow at 6 p.m. It's actually free for all the existing members of the How to Make More Money group. We've got the investing group, real estate, 0 to millionaire, stocks and psychology of money, you name it. These AI lectures, though, are going to be sick. They're going to be lit. I mean, just really, really good. So I'm very excited. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by